Knowing what fees you're paying when you invest in a mutual fund is crucial to your investing success. Today, we're going to look at some of the popular fees mutual funds charge. If you like what you see, give the video a thumbs up and subscribe to our channel. And as always, if you have any questions, post in the comments below, and I'll get back to you as soon as possible. Let's get started. Every mutual fund has a prospectus filed with the SEC. In that prospectus will be a table of fees. Here's an example of what that table looks like. Now let's take a closer look at some individual fees. There are two sections of fees: shareholder fees and operating fees. The shareholder fee section. A front-end load fee. This is when you pay a fee when you invest in a fund. If there's a 5% front-end sales load fee, so if you invest $10,000, the fund will automatically charge you $500, which is the 5%. Then there's the back-end load fee. This one is a bit trickier because there are often exceptions based on various criteria. If you look at our fee table example, you will see that there is no minimum deferred sales charge. But then they reference this number 1 footnote. The footnote basically says if you invest over $1 million and sell within the first 12 months, they can charge you 1%. This illustrates the importance of reading the prospectus. Mutual funds are required to describe their fees in this prospectus, and every fund is different, so make sure you read the prospectus so you can examine exactly what the fees are that they're charging. Now, every now and again you might hear about a no-load fund. Generally, what they're referring to are these front and back-end load fees. But I wouldn't just accept a no-load fund as having no fees in this top section. They could also list fees like exchange fees, redemption fees, service fees, and so on. So once again, find this table in the prospectus of the mutual fund you're considering and read the details. Now on to the operating fees. First is the management fee. A management fee are fees paid out of the fund's assets on an annual basis to the investment advisor for managing the fund. With our fund example, we'll see that the fee is 72 basis points. A basis point is 1/100th of 1%, so 100 basis points is the same as 1%. So in this case, it's 72 basis points. If the fee had been 1.5%, you could say 150 basis points. The next fee is a distribution fee, or a 12b-1 fee. 12b-1 fees are fees that are taken out of the fund's assets to cover expenses to sell the fund. This fee can include compensation for brokers, paying for advertising, printing and mailing the prospectus, and so on. Then we go down to other expenses. This can be a lot of different things. Some popular fees here are legal fees, custodial fees, some administrative fees, things like that. In summary, fees for mutual funds are impressively more complex than you might think. In my opinion, if I were looking to invest in a mutual fund, I would be looking for a no-load mutual fund that has annual fund expenses as low as possible. I might be willing to pay a slightly higher fee if there was a specific strategy I wanted to be involved in, but for a basic fund, I would be looking at the total annual fund fees, and I would be looking for funds that don't have a sales load fee. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.